we did have that surprise rate cut from the PBOC when it comes to that reduction in the repo rate from 1.8% to 1.7%. This is, as a reminder, kind of largely regarded as the closest thing that they have to a benchmark rate. Let's get some more from our Bloomberg Intelligence Chief Asia FX and Rate Strategist, Stephen Chiu. And Stephen, this is kind of interesting, right? Because I think Bloomberg Intelligence, we're seeing perhaps a bit more of a synchronized move alongside the Fed. This has come a little bit early.
Yeah, I think it's very interesting that all of a sudden this PBOC cut rates by 10 basis points today, because actually a market has been expecting for a PBOC rate move since January, but it has never really happened. Like, part of the reasons, actually two key reasons. Firstly is because of the yuan is under pressure against a strong dollar. Now that has been relieved somewhat just because the dollar retraces after that weak US CPI. So the yen also rebound, a lot of the other non-dollar currencies rebound. So therefore now it's probably a good timing in terms of the FX development. And the other key driver is actually the plunging China bond yields. And that has also rebounded recently because China has signaled that they're going to start selling CGBs just to support bond yields. So bond yields recover a little bit. So whether from an FX perspective or bond perspective, I think now it's an optimal window, especially off the third plenum. So China now can signal further support for the economy. And actually, most importantly is the timing, because now we know that China want to move away from the one-year MLF, because everybody now just looks at the 15th of each month for the MLF cut for a policy move. But now China said that they want to move away from that. They want to have the 7-day repo rate to be a more policy rate, so to speak. So that's why the timing today is actually perfect. Now they're showing that they mean it.
Stephen, we've also got traders now raising bets for a second Trump presidency. Now, what's a win going to mean in terms of Hong Kong's dollar peg? Does that make it a target?
I mean, it's going to be a very interesting focus going forward, because it doesn't mean that it's going to move the peg, because like back in 2020, there was this news floating that Trump's advisor, I'm not sure it's Trump himself, saying that they could revoke Hong Kong's dollar peg. But the fact is, like, the US can't do it because it's really decided by the Hong Kong government. It's under the basic law since 1983 that Hong Kong get to choose which currency to peg to and like whether they want to use a pegging system. So this time around, if the chance of Trump coming back rises as market has started to price in the so-called Trump trade, then one focus could be the Hong Kong dollar peg, especially once the Fed cuts rate and dollar Hongkie drops towards the 7.75, and then the HKMA may have to come out and start to buy dollars. And we know that now Trump is actually against a very strong dollar. So when they see that like Hong Kong is trying to sort of weaken its currency at 7.75, then that's a perfect excuse for them to actually attack the peg again.
All right, Bloomberg Intelligence Chief Asia FX and Rate Strategist Stephen Chiu there now.